In the tumultuous world of finance, there's a relentless red flag waving, one that's been flashing its warning for 212 consecutive days: the yield curve. This eerie signal, where short-term government bonds offer more substantial returns than their long-term counterparts, has historically been a harbinger of economic storms. It's a bit like watching a brewing thunderstorm on the horizon, and it's been brewing for quite a while. Picture this: the yield curve inversion, now the longest in over 6 decades, has some economists scratching their heads. It's not the first time this phenomenon has occurred, but this time it's different. Banks, which typically thrive on the interest rate spread, find themselves in a conundrum. With short-term rates soaring, their incentive to lend weakens. So, as we stand on the cusp of financial uncertainty, we must ponder: is this yield curve inversion a reliable predictor, or have economic dynamics shifted so dramatically that it's lost its crystal ball status? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button, leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. The financial world's persistent omen. What's behind the yield curve's unprecedented inversion? For 212 consecutive trading days, the financial world has been fixated on a signal that's more than just a little ominous: the yield curve inversion. This unusual occurrence, where short-term treasury bonds offer higher returns than their long-term counterparts, has proven itself as a reliable precursor to economic downturns throughout history. But as this streak continues, breaking records along the way, it's raising eyebrows and questions about its predictive power. Traditionally, when the yield curve inverts, it's a red alert for investors and economists alike. It suggests that the market anticipates economic weakness in the not-so-distant future. The logic behind this is simple. Banks typically profit from borrowing at lower short-term rates and lending at higher long-term rates. When short-term rates become more lucrative, they're less inclined to lend, potentially strangling economic growth. However, this time around, there's a twist in the narrative. The current inversion isn't solely driven by economic woes, but by the Federal Reserve's fervent efforts to combat inflation amid a period of robust economic growth. This unique circumstance has cast a shadow of doubt on whether this inversion will, in fact, predict a recession. It's a conundrum. Can the Fed declare victory on the inflation front and reduce interest rates without plunging us into an economic abyss? Market veteran Ed Yardeni has proposed an intriguing possibility that this inversion signals a triumph for the Fed. If they manage to tame inflation without stifling economic resilience, it could be the nirvana scenario. In this utopian vision, the yield curve could correct itself without dragging us into a recession, a scenario more economists are entertaining. Goldman Sachs, for instance, places the likelihood of a U.S. recession at a mere 15%. But, and here's the lingering risk that investors must confront, the consequences of the Fed's aggressive interest rate hikes might be lurking just around the corner. These hikes often have a lagged effect on the economy. Even if the Fed halts its rate hikes for the remainder of the year, the repercussions of the more than 10 increases already implemented could still seep into the economy, potentially leading to a downturn. History serves as a cautionary tale here. Past yield curve inversions have sometimes persisted for as long as 18 months before a recession struck, such as in 1980. Similarly, the inversion in July 2006 didn't precede the economic downturn until 15 months later, in December 2007. So, while the economy's remarkable resilience has cast a shadow of doubt on the reliability of the yield curve inversion signal, it's far too early to declare smooth sailing. The storm may be delayed, but the clouds still loom on the horizon. As we navigate the treacherous waters of financial uncertainty, we must ponder: does the yield curve inversion still hold the power to predict economic storms, or have the rules of the game fundamentally changed? What's your take on the current state of the economy, and do you believe the yield curve's warning still deserves our unwavering attention? Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.